Welcome and thank you for joining us for today's PENTalk. If you have any questions during the presentation, please submit them through the question box and we will follow up with you after the presentation. Tomorrow you will receive an email with a link to replay today's broadcast. So let's get started. Hosting today is Dave Bearer, National Director of TPA Markets at Pentegra. Dave has nearly 40 years of experience in the financial services industry. His vast degree of knowledge and enjoyment for helping advisors better assist their clients and expand their practices has made him the go-to expert for 316 fiduciary outsourcing and TPA services. And with that, I will now hand things over to you, Dave.
Thank you. And everyone, thanks for joining. Appreciate it today. We're going to talk about the new fiduciary rule, what I think is interestingly being called the final fiduciary rule. I think that's a bit optimistic since we first had this legislation, fiduciary legislation, passed in 1975, a year after ERISA was signed, and we've spent the last 14 years trying to change it with various failed attempts. So any notion that this is the final, I think, is kind of interesting. But nonetheless, we will press on. I am a student of this new rule, much as everyone else, all of you listening are. And what that means is I'm not an expert. I'm studying it just as you are, and we're presenting facts and evidence as we know them, and we'll talk about the challenges to this legislation or to this law, and see where we end up. So we're first going to go through an overview of this new law by the DOL, and we're going to talk about why does it matter to a plan sponsor, to a retirement plan sponsor. Excuse me. We're going to go through the new definition of what an advice fiduciary is, the old 5-part fiduciary test versus the new rule, fiduciary carve-outs, prohibited transactions, rollovers, investments, and so on. And we'll see how far we get. We've got an hour. I actually don't think we're going to take an hour today, folks. I think we're going to be able to give you back a little bit of time and answer your questions after the fact. But we'll see. So on April 25th of this year, the Department of Labor published its retirement security rule. So I used legislation. It's not legislation. There was no legislating of it. It was the Department of Labor issuing a rule. Definition of an investment advice fiduciary. Package of finalized regulations and amendments to several advice-related prohibitive transactions came with that. So the final rule defines when an entity or person is considered a fiduciary in connection with providing advice for a fee to a retirement investor. That's a new definition or a broader definition, and seeks to protect those retirement investors from harmful conflicts of interest. The age-old example of an advisor who helps an employer adopt a retirement plan, and they provide advice to that retirement plan throughout many of the employees' careers. And when the employees roll out at retirement, the same advisor often helps them with their rollover and other retirement investments. That's, after all, the way most advisors build their practice. They are wealth managers first in many instances, not always. There are any number of focused groups around the country that focus strictly on the qualified retirement plan, but an awful lot of advisors over the course of their career build up a book of a dozen or more qualified retirement plans with the objective of helping people accumulate assets and resources while they're working, and then helping them manage those assets and resources in retirement. And perfectly natural, makes a lot of sense. The final rule defines when an entity or person is considered a fiduciary in connection with providing advice for a fee. The final rule as well as the amended prohibitive transaction exemptions, PTEs, because again, we all love our acronyms, are effective December 23rd of 2024. Maybe. We'll talk more about that in a little bit. The amended PTEs 2020-02 and 84-24 include a one-year transition period after the effective dates, under which the parties must comply with the impartial conduct standards. We'll talk about those as we get going here too, and provide a written acknowledgement of fiduciary status or relief under prohibitive transactions. So again, there are prohibitive transaction rules that control whether an advisor may be compensated for providing advice. There are exemptions under those rules that rely on impartial conduct standards. That's one way of keeping this in mind as we go through this today. So why does this matter to a plan sponsor? Well, plan sponsors are fiduciaries, and they're included in the definition of retirement investors also, right, because they're employees who are participating in plans, and they are the beneficiaries of the new rules. So plan sponsors need to be aware of it. Plan sponsors also may want to review the extent and scope of that monitoring obligation with their legal counsel and discuss with their providers how they intend to comply with the new advice fiduciary rules. And the final bullet here, there may be situations in which a sponsor themselves might be subject to this, or might be considered an investment advice fiduciary. Now, I think that's a bit of a stretch. One of the credence of the rule is that they have to be receiving compensation. So I think it's a bit of a stretch to think that an employee's participation or employee's effort working for an employer, I don't know how that could be construed as compensation to the employer or to the owner who might be giving investment advice to a committee or something like that. Think about it. In some instances, retirement plans have committees, and sometimes the owner sits on the committee, and if the owner provides investment advice, there still is some question about whether they're receiving compensation. Sometimes, there are still handfuls of profit sharing and money purchase plans for which employers serve as the trustee and investment fiduciary, make all the investment decisions for a pooled program. Are they a fiduciary there? Yes, they certainly are. Are they a fiduciary subject to this law? I think it's a bit of a stretch that they would be, but nonetheless, there's some legal standing that they might be, which is why it's being covered in this slide deck. So out with the old, in with the new. We have the definition. So this reads at the high level. The DOL rule reads that a person or entity will be an investment fiduciary, advice fiduciary, subject to ERISA standard of care, loyalty, and prudence in the following, if the following are true. The provider makes directly or indirectly a professional investment recommendation to a retirement investor for a fee or other compensation. It's that other compensation that has attorneys wondering, well, how far and wide? What does other compensation mean, and how far and wide does that extend? The provider holds itself out as a trusted advisor, and so it's the first one, and the same person or entity holds itself out as a trusted advisor by specifically stating that it is acting as a fiduciary, or making the recommendation in a way that would indicate to a reasonable investor that it is acting as a trusted advisor, making individualized recommendations based on the investor's best interest. I think that's true of most investment advisors, that they that they provide advice based on their knowledge. That they are acting in a fiduciary capacity. They are making recommendations in a way that would indicate to a reasonable investor that they're acting as a trusted advisor. They're not often making these things offhandedly, and individualized recommendations on the investor's best interest. These are the standards by which this the DOL rule runs. So again, directly or indirectly, it makes them a professional to a retirement plan for a fee, if they're doing so for a fee and or other compensation, and these two other check marks down below. And it's that other compensation that has people searching and researching and wondering exactly how far and wide does that extend. The final reg also explicitly provides the following exceptions. Sales pitches are not fiduciary advice. A recommendation provider does not provide investment advice if the provider makes a recommendation that would not fit the new definition. So, how loosely interpreted is that? Well, clearly, an advisor recommending a record keeper provider based on saying, well, they have great participant services, they have great educational tools, and they have great target date funds, and we'll do a great job for you. There's nothing specific about those types of statements. Later on, I think in one of the other slides coming up, I think it says, it alludes to the fact that the more definitive advice or conversation gets, the more likely it's going to be treated as advice under the new rule. So that's something else to keep in mind. Disclaimers are not controlling. So written statements disclaiming a fiduciary status will not control the extent they are inconsistent, to the extent they are inconsistent with the person's oral and other written communication, marketing materials, applicable state and federal laws, other interactions with retirement investors. So that was something that oftentimes was relied upon in the past, that conversations, if you will, were subject to disclaimer, or conversations were, yes, we had a conversation, but what I submitted to you in writing had a disclaimer attached to it, and the disclaimer said something to the effect that past performance is not indicative of future returns, or something to that effect, or I am not serving as a fiduciary, regardless of what I say or do. A very important point of the DOL's rule is that the disclaimers are not controlling, something that wasn't actually covered before. So the new advice test under the rule, it changes the regular basis requirement. This is a key point, and I've got to admit, I went back and read and reread this several times just to make sure that I was understanding it. The bullet point here reads, changes to the regular basis requirement to one that simply requires the advice fiduciary to be in the business of providing professional investment advice on a regular basis. So the old rule was that the person was providing retirement advice, this specific advice, on a regular basis. So let's give an example. If somebody, that same advisor that I said over the course of their career, maybe they accumulated a dozen retirement plans. Well, when they accumulated the first one, they were likely in the wealth management business, They came to the office every day and they called on people, or they walked around the neighborhood and talked to people, or whatever. But they were helping people with their investments, helping people with various things. Maybe life insurance was involved. They were a financial planner. And when they got that first retirement plan, they were not at that point in the regular business, or they were not doing retirement work on a regular basis, or qualified plan work on a regular basis, because they just had their first one. Well, so the definition have changed, and now instead of being in the retirement plan business on a regular basis, now as long as they are in the business of providing professional investment advice on a regular basis to their clients and customers, they can potentially be considered to be an advice fiduciary. The second bullet point here makes the question of the advisees and cumbersome reliance on the advisor's recommendation one of fact. Again, the circumstances that would indicate to a reasonable investor in like circumstances that the recommendation is based on a review of the retirement investor's particular needs or investment circumstances. These two things are I think, kind of key. And actually, I think the first bullet point is something to be very aware of if you're an investment advisor, that you're a casual practice, or a small part of your practice. I know advisors who at one point in time actually related their practice to the percentage of assets under management, or percentage of income that they received from retirement plans versus everything else. And when it was below 50% or below 40%, they often felt, well, it's more of a casual part of my business as opposed to a focus. Now, according to this rule, it doesn't matter. The new fiduciary test under the retirement security rule provides that disclaimers by the advisor will not control. We're going to a little more detail here. The extent they are will not control to the extent they are inconsistent with a person's oral or written communications, marketing materials, applicable state law. And this eliminates the old rule's primary basis language, instead of requiring only that the recommendation is made under circumstances that would indicate that the recommendation may be relied upon by the retirement investor as intended to advance the retirement investor's best interest. Here again, we're shifting from an old rule that said that that the primary basis of the material had to focus on this, to something that says that something's a lot more loosely interpreted. So and again, this notion that that a disclaimer will override other language in material being delivered doesn't provide a safe harbor or anything like that. So fiduciary carve-outs. What doesn't contribute to fiduciary status for certain specific circumstances? And they use the terminology in the rule: a hire me communication without an accompanying recommendation made in the normal course of marketing, advisory, or investment management services generally may not be considered investment advice under the rule. And that's a logical assumption, right? It means that we're not we're able to send things out as an advisor, or advisors are able to send things out, soliciting business that don't provide advice that in any shape that are that don't contribute to their participation in as a fiduciary. Platform providers and pooled plan providers. This is particularly important to Pentegra. We are a pooled plan provider many times over for pooled employer plans. Platform providers and pooled plan providers who merely identify investment alternatives may not be considered an investment advice fiduciary. As a pooled plan provider, we often control the choice of record keeper custodian and maybe the overall availability of investments. Pooled employer plans have a 338 investment manager who does step into a fiduciary status and makes the decision of choosing which funds are available and which funds are not available in the plan, and they prudently select, monitor, replace when necessary the funds. But oftentimes, as a triple P, we are responsible for the overall platform availability, and the rule indicates that we are not a fiduciary in that instance. Likewise, the record keeper custodians, and you all know the names out there, the Empowers and Fidelities and Vanguards and TIAA and Transamerica and whomever else. You know, the minute I start mentioning names, if I don't mention everyone, then I'll get yelled at by somebody. But they in turn are not fiduciaries simply by providing a platform with investments available. So again, under the rule, the DOL provides carve-outs from fiduciary status. Valuation services, appraisal services, fairness opinions are not considered covered recommendations under the rule. So in instances where employer stock, for example, is in a plan, the companies that provide a valuation or an appraisal or a fairness opinion of those stocks, they are not considered covered under this rule as a fiduciary. Wholesaling activities, generally not investment advice, for example, the interaction between a wholesaler and a financial professional who might also be a plan fiduciary, it's not likely that it's going to be investment advice under the final rule because it's not based on an individual need. Most of the time, a wholesaler is going to tell you what they have available in their platform, and they often can provide detailed information about the platform. Similarly, a DCIO representative, they are providing information about their investments, but they're not making specific individualized advice. Nothing's based on an individual person here. They're just providing broad scope information about target date funds, managed accounts, whatnot. Rollovers, investment policies are considered advice. So this goes back to what I brought up a little bit ago early on. An investment advisor making a recommendation to roll out of a retirement plan is providing advice under the reg. Not because they're necessarily to the point of providing specific investment advice, but merely the advice to a participant to roll out of their qualified plan into, say, an individual retirement account or some other vehicle is generally considered advice under this rule. An investment policy or an investment policy statement or a strategy or a portfolio composition selection. These are all advice, part of the rule as well. And it's not uncommon for an advisor to sit down with an investment committee at an employer for a sponsored plan and to help them map out an investment policy statement, to show them the 9-box grid, if you will, of growth and value, large, mid, and small, and even the coaching of, you need to cover all or most of these boxes with one or more selections, or to make those available, and helping that committee decide how often they're going to meet and how many times a year they're going to meet, what the content of their meeting, all of those things would be considered, would be included as fiduciary advice under this regulation. Amended prohibitive transaction exemptions, PTEs. This gets a little bit into the weeds, so I want to move slowly through this. Again, I said at the very beginning, and I'll say it again, I am a student of this rule. I'm not an expert of this rule. But like you, I am studying it closely so that I can be of help to everybody. So the first bullet point here states that, with respect to a particular transaction, an advice fiduciary receives compensation that creates a conflict of interest for them, the transaction may be prohibited and therefore require the use of a PTE, a prohibitive transaction exemption, to proceed legally. The final rule package contemplates the PTEs available for the management of conflicts of interest with respect to fiduciary advice, two of which are 2020-02 and 84-24. Both exemptions require that investment recommendations adhere to impartial conduct standards. So, 2020-02 allows a broad array of investment advice fiduciaries to receive compensation that would otherwise be prohibited, given that they comply with the exemption's conditions. 2022 relief, as amended, is conditioned in part on the following: compliance with impartial conduct standards, which means, one, providing advice in the advisee's best interest through satisfying the care and loyalty obligation described in the PTE, charging only reasonable compensation, and making no materially misleading statements. So what's reasonable compensation? Kind of depends on the amount of labor involved, doesn't it? We don't have an answer here today. There are varying opinions on what reasonable is. There are any number of resources that can be found to gain an idea of what industry-wide compensation is. Most registered advisors will have a home office compliance team that will tell them what reasonable compensation is. For those that are not registered reps, but other investment advisors, they still have compliance departments that will help them understand or make that determination of what reasonable is. We have a tendency, there are times when we are required to engage a 338 investment manager for a pooled employer plan, and we have enough pooled employer plans and multiple employer plans to know now what reasonable compensation is, based on what we see, not only in our book, if you will, but in the industry. With respect to rollovers, prior to the rollover, producing documents of the reasons a recommended rollover is in the advisee's best interest are required to satisfy the PTE. The affected financial institution acknowledges fiduciary status and describes the services it provides as any material conflicts of interest. And the affiliated financial institution adopts policies to ensure compliance with the impartial conduct standards and conducts a respective review of compliance certified by a senior executive level. So again, oversight of the financial advisor by a senior executive officer who agrees with what's being recommended and what's being charged. That's the most prudent way to satisfy 2020-02. $84.24, tailored for use by independent insurance agents who recommend non-security annuities issued by more than one insurance company. The DOL added a new section to the PTE to provide relief for independent insurance agents providing fiduciary advice subject to conditions like those in 2020-02. Unlike 2020-02, the insurance company selling its product through the independent agent is not required to provide a fiduciary acknowledgement and is not treated as a fiduciary merely because it exercised oversight responsibilities over independent agents. Let's pause there for a minute. So, independent agent, and recently I've been involved in something very similar to this. We had a nonprofit employer adopting into a MEP, have an existing 403B plan, and their 403B plan was an old tax-deferred annuity plan, meaning that it was just employee deferrals. There was no employer contribution. The employer exercised no oversight over the program. The program consisted entirely of individual annuity accounts issued by a very small Midwest insurance company. And that insurance company's independent agent was the person who sold the plan and sold the annuities and all of that. So he is the kind of person who would be affected by this rule, and he now, under this rule, is a fiduciary, and he has to abide by the same standards that we talked about back here in 2020-02. However, the insurance company issuing the annuities is not held to the standard. Oh, sorry, let me go back. Is not held to the standard back here that the financial institution is not required to adopt policies to ensure compliance with the impartial conduct standards. That insurance company is not required to do that. They are required to provide oversight. The insurance company is required to exercise oversight of the independent agent to monitor whether an agent should be authorized to sell its product. Most of the time, what's going to go on there is the insurance company is going to provide training about their product and ensure that the agent understands what the product is, how the product runs, how the product works, what's required to sell the product, and what their obligation is in delivering, and so on. So it's going to be a bit of a challenge. And this, by the way, this is the part that is right now under scrutiny. So I said early on that this is called the final rule, and I said maybe. It's already challenged. It was the first challenge was in a lawsuit filed by the Federation of Americans for Consumer Choice on, I believe, May 14th or 15th, May 14th, I think. So they are challenging in court the validity of this rule. Another lawsuit that's been filed is the American Council for Life Insurers. So that's a political action committee formed by insurance companies. So its members are insurance companies, and they have filed suit. And so two lawsuits challenging the DOL's ability to issue this rule. And in addition to those two, Congress, I'm looking at my notes here, sorry, I have to glance away for just a second. Congress has, well, I didn't write it down specifically. Congress has the ability to challenge this as well, and they have. And it's under a particular act. And if you know what, I'll add it to the notes when we make this available tomorrow. The congressional challenge, I think, is unlikely to succeed because it will very likely, the time frame for that legislation means that it will Congress will either vote to pass legislation to void this rule by sometime in September, or it'll get kicked into the 2025 Congress. And if they vote now, but between now and September, it's very likely going to be it's going to be vetoed by President Biden. And I think that, and I don't think Congress has votes to override the veto. So, three separate challenges on two different fronts. One is congressional, unlikely to succeed. The court cases, I think, I think I mentioned earlier, Empower did a great session on this earlier today. Bob Holcomb and Kelly Rome ran that, and I'm quoting Bob Holcomb here. I think that we think that the court cases may succeed in getting the judge to issue a stay of the adoption, if you will. If you remember, this goes into effect in September, and I think it's likely that the court cases might get a stay to this. The reason, the rationale there is that the court cases were both filed in the same district, and I can't remember the district off the top of my head, but in the same district that the 2016 court case that overturned the 2010 rule, same district, same court. So and the other, part of the cases that are being offered is that this rule varies somewhat from the 2010 rule, but not much. And the 2010 rule was overturned. So remember, when we talk about the current existing rule, that's the 1975 rule. We had a new rule passed in 2010 that was overturned in 2016, and now we have a new rule passed in offered up in 2024, and the court cases against the new rule are in the same district court that the 2016 overturned the 2010 rule. So, sorry, a lot of stuff there, but I think it's likely that these court cases will at the very least get a stay, and then we'll see what happens after that. To wrap up the independent insurance agents, the DOL has been obsessed with this for years. They are convinced that that tens of thousands of Americans are unduly influenced by insurance agents to roll money out of their retirement program into an annuity, and an agent is making a fortune off of these. In some instances, that's probably true. Is it as widely spread as the Department of Labor believes it is? I doubt that, but I don't have those statistics, don't know those statistics, so would be hard for me to conclusively say anything about it. Told you we probably wouldn't make it an hour. In conclusion, with a tightening of the investment advice rules, more individuals will be providing fiduciary advice, subject to ERISA's strict standards as of September 24th, 2024. That's the projected effective date. Prior to finalization, interested industry parties filed over 19,000 comments with the DOL. Since the rule passed, and this is what I mentioned, at least one lawsuit. There are actually two in federal court. I said district court. I'm sorry, federal court, opposing the new rule, and there is a congressional effort to overturn the rule as well. That's all I had today. Thanks for joining. Again, submit your questions. We'll do our best to answer them. And also look around. I mentioned Empower, not because they are exclusively providing stuff like this. Most of the larger record keepers are doing something similar. Theirs was very good and is probably available on recording, just as this will be available. Lizzie, you want to take us to the end?
Sure. Thank you very much, Dave, and thank you everyone for attending today's PENTalk. As mentioned, you will receive a recording of the presentation tomorrow. Thank you, and everyone have a great rest of your day.